Hey everyone, George here. So if you're a construction contractor and you're doing well, say 6 figures or above in net income, you probably know by now that taxes can really eat away at your profits. So today I'm going to go over one of the most powerful tax strategies that you can use to build your wealth, your investments, everything completely tax-free. And this is one of those secrets that a lot of very wealthy people know and most other people don't. So without further ado, let's get started. So pretty much all construction business owners are positioned very uniquely, very different than say W-2 employees. I tell my W-2 employee clients, like, unfortunately, there's really only so much we could do other than 401k contribution or something. But as a business owner, you have all this leverage in terms of what you can use in the way of tax strategies. So this is definitely one of the big ones. So as a construction business owner, you often have high income, irregular cash flow, business ownership, equipment, real estate, and real growth opportunities. And with all that comes a lot of control. Like, I know that was like quite a list or whatever I just threw out there, but there's so much leverage, leeway that we have right now with that in terms of tax planning. I save my clients millions every year on tax planning and tax strategies, and this is one of those ways that isn't even recorded in that number. This is like way down the line. So basically, this strategy is using or leveraging the concept of a Roth plan. But you might be thinking a Roth is just for, mutual funds and my retirement. And that's where you're flat out wrong. When structured properly, Roth plans can hold alternative assets. And this is where things get interesting. A Roth account means you pay the tax once upfront, and everything that grows after that is completely tax-free. No capital gains tax, no tax on withdrawals, no required minimum distribution for the most part. Compare that, for example, to real estate or business exits outside of a Roth plan, where taxes can easily get to 20-40% of your profits. Now, here's the key idea we're getting at. The IRS doesn't care about the growth in your Roth. They only care about when it's funded. So the game changer here are self-directed Roth plans. Depending on the structure, a self-directed Roth plan can hold real estate, private lending, LLC interests, and closely held business shares. This is not a loophole. It's explicitly allowed under the tax code. But it must be done correctly. The Roth itself doesn't do the work. The asset inside is the one that does the work. Now, for example, if you bought a property for, say, $300,000, but you bought it through a self-directed Roth that's structured properly instead of you personally, and assuming this property had strong rental or development upside, the rental income grows tax-free, the appreciation grows tax-free, and the sale proceeds eventually when you sell it are completely tax-free. So if, for example, a $300,000 property went and eventually down the line, years later, sold for $1 million, that $700,000 spread is completely tax-free. Important rules are that there's no personal use of the property, there's no self-dealing, and expenses and income flow directly through the Roth. And this is not DIY territory. This is, you should get professionals involved to structure it correctly. We just went over a real estate example, now a business ownership example. So think of it like you invest or start a business early on. That business grows significantly, and eventually you have a sale or exit or distribute profits. Outside of a Roth, there's capital gains, ordinary income, but inside a Roth, that growth is completely tax-free. This is often done at early valuation stages with minority interest and careful compliance. This is not about hiding income, it's about placing it where it's never taxed again. Contractors who launch side ventures, buy into operating companies, and invest in development entities have enormous planning opportunities here. So again, none of what I said is aggressive, none of it is shady. This isn't something the IRS doesn't know about. What is risky is doing it without proper advisors and proper professional care, overvaluing contributions, and violating self-dealing rules. That's why this works best for high-income contractors, owners with long-term vision, and people who want to keep wealth. So if you're barely surviving month to month, this is not a good time for this strategy. This strategy is ideal if you're, for example, just about to start your construction business or are about to invest in a construction partnership or interest, have surplus cash beyond daily operations, or invest in real estate or private deals already. And either real estate or business if you're expecting good appreciation over the years and eventually plan an exit. I mean, remember that not just real estate, but your business. You can eventually sell it for multiples of EBITDA. Like usually what I've seen in construction between 5 to 10x of EBITDA, which is basically your bottom line. So either the business or the real estate, property, if you plan to sell it, say 5, 10, 15, 20 years down the line, you're going to get hit eventually with a big tax bill between federal and state. So this is a very powerful strategy or tool to properly structure yourself to avoid that tax bill. So again, this episode, this is for your education, obviously not specific individualized tax advice. To get these set up properly, I would highly recommend consulting with a professional or somebody who knows what they're doing on this end. This is not a DIY task by any means. I hope you found this helpful. If any of this applies to you, please email me or book a time. The links are down in the show notes, and hope to see you in the next one.